So what do you need to know now to be ready for the spring and summer 2024 market in Colorado Springs? So we all know that the Colorado Springs real estate market picks up the closer we get to spring and summer and when school gets out. So today, that's why I'm here in the studio. We're going to take a look at 5 things that you must consider when moving to Colorado Springs. And we're having these conversations with our clients all the time about getting into this Colorado real estate market this year and what that looks like. Hey, what's going on, everyone? This is Lori Derrickson with Colorado's Finest Agency here in Colorado Springs. My business partner and I, Kayleen Zabadick, we sell hundreds of homes here each year and help clients make that move out here to Colorado Springs. We'd love to help you. So check out our 5-star Google reviews and drop those numbers into your phone and give us a call or text anytime. We'd love to help answer all your questions on moving to the Colorado Springs area. So what we must acknowledge that financial tightening may not just be over yet. And interest rates could rise again, although they're predicted to go down. But currently the Federal Reserve has halted those rate increases. But this pause is due to other economic factors taking on the burden, eliminating the need to further action that needs to be done by the feds. So you may be wondering what I'm talking about. A key player in this scenario is the secondary mortgage market, which you may have heard of. It significantly influences this situation. So the secondary mortgage market serves as a platform where banks and other financial institutions sell these mortgages they've issued investors, and they've sold these mortgage-backed securities. So this process is as crucial as it allows lenders to acquire additional funds for issuing new loans, thereby helping to regulate mortgage rates. So think about government-sponsored enterprises like Freddie Mac and Fannie Mae. So let's just pause and introduce them. They are also major participants in this market, contributing significantly to these dynamics. So it's important to recognize that the current phase of financial tightening may not be over. There's a possibility that interest rates could rebound, although we're not predicting it, but we're seeing the Federal Reserve has stopped increasing these rates for now, but it's largely because of other economic forces that are effectively doing the work, reducing the need for further rate hikes by the feds. So a significant factor in this context is the role of the secondary mortgage market we talked about. In this market, banks and other lending institutions, they sell these mortgages they have issued to investors. These transactions involve mortgage-backed securities, which are instrumental in this process. So by selling these securities, lenders gain access to more capital, allowing them to offer new loans. This mechanism plays a vital role in maintaining the stable mortgage rates. So government entities that we talked about, Freddie and Fannie, are also key players in this market and greatly influencing how it functions and how it operates. So think about during COVID, the feds were buying billions of dollars of these mortgage-backed securities. So an article by Econ Focus states, as a result of these purchases during COVID, the size of the Fed's balance sheet more than doubled from about $4 trillion prior to the pandemic to nearly $9 trillion at the start of 2022. So that's a lot of secondary buyers in that market. So the Federal Reserve was actively purchasing these mortgage-backed securities in large quantities, playing a significant role in the housing market. However, the situation has recently shifted and the feds have ceased buying these securities in an effort to reduce their balance sheets. So this means a major buyer has exited the market, which could raise some concern. But it's not all doom and gloom. There are still other potential buyers in the secondary market. From an investor perspective, the mechanics of a profit making in this scenario are worth considering. So investors earn from mortgage-backed securities through their interest, which is accrued on the underlying debt. However, acquiring these securities involves various fees, closing costs, think about it. So therefore, it usually makes some time for investors to recoup these initial expenses, which is an important factor in their decision-making process. So the issue lies, so here we're getting to how wrapping this all up, with the current sentiment among buyers in the secondary mortgage market. They're skeptical about the longevity of these mortgage-backed securities, particularly with the expectation, now imagine this, that homeowners will refinance rates once they fall below 5%. This skepticism isn't unfounded, as refinancing at lower rates is a common goal for homeowners, right? So consequently, to attract investors, mortgage rates need to be set higher. Investors typically look for immediate returns rather than waiting for the long-term returns on their investment. They anticipate that homeowners will refinance, shortening that expected duration of their investment, which adds risks from their perspective. This scenario also explains why lenders are often eager to pay points to offer lower rates, and by doing so, accelerating their profit making on that investment. So with the Federal Reserve stepping back from purchasing those mortgage-backed securities, and investors showing reluctance towards them, we begin to see an alternate path to those rising mortgage rates. The Fed's achieved its objective by reducing its balance sheet, right? But a process that is more gradual and less visible than direct rates. So this subtle approach of balance sheet reduction is unfolding over time and probably largely out of the public eye. So all this to say that a recent article from Reuters now states that the Wall Street's biggest banks shifted ahead of last month's Federal Reserve meeting towards predicting that the central bank would end its balance reduction process. Further stating which minutes from the Fed's meeting last month, which were released on Wednesday, noting that some officials are now ready to talk about how and when the end of this qualitative tightening will happen. The question has been on the minds of investors and traders given the apparent end of the current rate hike cycle and rising bets on its financial markets that the central bank will be cutting rates as soon as this spring as these inflation pressures wane. So the strategy of the Federal Reserve employs balancing those interest rate reductions by also managing and maintaining their balance sheets, and those significantly influence how they do this, the spring and summer real estate market, how this unfolds here in Colorado Springs. As we're all aware, there are numerous other variables that need to be taken into account in this scenario. So this is where factor 2 comes into play, the bond market. A recent article by U.S. Bank sums up the bond market and what to expect in 2024. So they state after bond yields rose sharply in late summer and early fall of 2023, up to 5%, yields fell in the closing weeks of October and continued that general trend into December of this last year. The change in the direction for the bond market reflects the growing confidence among investors that the Federal Reserve is finished with its short-term interest rate hikes and will likely begin cutting rates in this year. So Mertz goes on to say 3 factors drove the jump in bond yields. First is the Fed's policy response to inflation. Second is the strength of the U.S. economy. And finally, there is an increasing supply of the U.S. Treasury securities coming into the markets. So the bond market and interest rates are key elements in shaping the future of the real estate market across the country and here in Colorado Springs. And you might be wondering how this impacts you, especially if you're considering moving to and buying a home here in the Colorado Springs area. Well, we'll address how these factors specifically affect our local real estate market and what we're seeing here on our end towards the end of this discussion, hopefully wrapping all this up for you. However, before we do that, there are 2 more important aspects that we need to consider. So yes, number 3, we're going to say it, is the election year. So it's important to consider the impact of it being an election year on the national and local real estate markets in Colorado Springs. So as much as I hate to say it, it is an election year and it often brings a sense of uncertainty, and people might also present unique opportunities. Who knows? But while the Federal Reserve is meant to function independently from the government, there's a prevailing belief, which you may have heard of, that lower rates could be favorable as we head into November of 2024, a sentiment commonly seen in major election years. So an election year is often unpredictable, especially in the real estate sector. So typically we see a decrease in total sales volume as the election approaches. This is likely due to people's natural dislike of change, uncertainty, which is understandable. So the question remains, what will the spring and summer of 2024 look like, which we're talking about here for the real estate market here locally in Colorado Springs? So given the circumstances, it's likely to be quite distinct from typical market trends. So people have been waiting on the sidelines for over a year, right, due to those increased interest rates in the 7s and 8s. And now with them coming down during an election year, will those people jump into the market? So a recent article by Forbes states, with today's favorable economic outlook, when it comes to mortgage rates, unemployment, and consumer confidence, the upcoming presidential election might do little to impede first-time home buyers or those shopping for lower to median value homes. So now we're going to shift our focus to those home prices. So that Forbes article suggests that they might remain relatively stable, largely due to the ongoing issues of tight inventory. You probably have heard of that. The concept of tight inventory levels significantly influences the supply and demand dynamics of the real estate market as well. It's well known. So now, before we get all into report number 4, I quickly want to remind you of our big green box promotion coming this year in 2024. So we just had 3 clients get their big green box in the first few weeks of January. It was really fun to see. So not only do you get to work with us, one of your best relocation teams when you're moving here to Colorado Springs, but at close, our clients choose from 6 luxury closing gifts. So in your new home, you might have your new Dyson vacuum and iRobot, or you may have your brand new snowblower lawnmower package for that Colorado snow that comes, or a Louis Vuitton bag for your new walk-in closet. So make sure to reach out to us today so we can answer all your questions on moving to Colorado Springs or the surrounding area. So drop those numbers into your phone and reach out. All right, so the 4th thing that may influence our spring and summer market is consumer cash and the CPI. So as we move into 2024, it's important to be aware that both consumers and companies are likely to experience a tightening of cash available to them. So this financial constraint could lead to a decrease in the Consumer Price Index CPI for both groups. Investopedia explains that the Consumer Price Index measures the monthly change in prices paid by U.S. consumers. The Bureau of Labor Statistics calculates that CPI as a weighted average of prices for a basket of goods and services representative of the U.S. consumer spending. So the recent price hikes every day in those items like eggs we've heard about, increasing from $2.99 for a dozen to $8.99, or that coffee going from $3 for that bag to $8, significantly contributes to changes in the CPI. So up until now, both consumers and companies have managed by dipping into their cash reserves. Even when their income wasn't sufficient to cover all the expenses, adjusting to these changes can take time. So as a consumer, think about it. If you're accustomed to dining out regularly, altering this habit can be challenging, as we all know. Similarly, for someone like me, those daily visits to that coffee shop become a routine. After all, caffeine is a necessity, a must for survival. However, in response to these financial pressures, many have resorted to accumulating debt, thereby depleting their cash reserves. So this trend is evident in the soaring levels of credit card debt currently being witnessed. CNBC recently reported in December of 2023, so just month and a half ago, that Americans have racked up over $1 trillion in credit card debt. Marley J with NBC News says U.S. consumers, get this, took on $43 billion in additional credit card debt during that second quarter of this last year. She continues going on to say that more than triple the average amount of new debt households take on since after the recession of 2007 and 2008. So the fact is that the number of refinances are also up right now, as reported by a recent CNBC article. According to the Mortgage Banker Association, in the last week of November of 2023, applications for mortgage refinancing increased by 14% from just the week prior. So consider this. Why would someone opt for refinancing at a rate of 7.5 if not due to financial constraints or restraints? Strains they're feeling? It's likely that they're looking into cash out refinance or perhaps need to consolidate various expenses. This would include addressing an escrow shortfall following a significant increase in their mortgage payment, or compensating for the reduced financial buffer that many consumers have when interest rates were lower. So during these uncertain times, if consumers find a way to significantly boost their savings through cash out refinance, they probably will take advantage of it. And the average homeowner could potentially, rack up hundreds of thousands of dollars in cash by managing and at the same time manage to maintain a similar monthly payment, or at least covering their immediate expenses. So if they're feeling that financial constraint, most homeowners, they witness their property values up by 20%, so they have this little extra cash sitting there where they can pull out from a refinance or a HELOC. So NBC News reported pandemic savings are largely spent down for most income and middle income and lower income households. So Fannie Mae put it like this. They say that the pandemic-related built-up household savings have supported consumer spending longer than they had expected, providing unforeseen support for the economy at large. The forecast for the early month of 2024 suggests a potential downturn attributed to the expectation that consumers will start to curb their spending. This change in consumer behavior is partly due to the depletion of previously available funds that they had and the need to establish a more sustainable balance between income and expenditures. So in the commercial sector, the impact is also being felt, particularly with commercial loans. These loans, unlike long-term mortgages, have shorter durations and come due much sooner. Take, for example, a company that needs to refinance either due to financial challenges or simply because their loan term is ending. If they were previously benefiting from a 3% interest rate, which we see many businesses and homeowners were, they're now facing refinancing because their loan terms are due at significantly higher rates of like 8%. So this substantially increases their loan and inevitably leads to tightening budgets for these companies. So the answer is definitely yes. All right, so you waited this long. We went through all of that. So now let's talk about the local Colorado Springs real estate market and what we're seeing. So according to data by RE Colorado activity, we experienced seasonal decreases as we approach the winter months. Closings were down by 9% compared to the previous year, marking the third consecutive month of month-to-month decreases. Despite this, home buyers executed contracts. There was 2,678 listings, reflecting a 3% increase from the previous year. So economists anticipate a surge as mortgage rates normalize and go below 7. So in November, Colorado metro areas witnessed a 9% decrease in closed listings compared to the same month in 2022. Additionally, there was an 11% reduction from the preceding month, marking a downward trend for the third month in a row. Yet, in contrasting trend, the median closed price for homes in November was $565 in Denver and $485,000 in Colorado Springs, a slight increase of more than 1% from the previous year, which varies by region. However, this figure represents a 3% decline from October to November of 2023. So these statistics seem somewhat conflicting, and they're sending conflicting signals. So analyzing these data trends reveals a modest decline in Denver and Colorado Springs home prices around the region to around the middle to early of 2023. But in recent months, there has been some noticeable upticks in prices because Colorado's reputation of one of the top long-term real estate investment markets in the U.S. It's bolstered by our robust economy, which empowers buyers to invest more into housing, driving up real estate prices. So the surge in home values over the past 6 to 7 years has significantly impacted affordability here in Colorado, particularly for individuals earning a medium income in the area. The data indicates like a slight decrease in home values, with an overall decrease of 1.4 over the past year in Colorado Springs. However, the market remains resilient with a balanced median sales to list ratio. So the verdict is out on interest rates, which will all come into play when we see the Colorado Springs market play out in 2024. We're seeing more and more negotiation power on the side of our buyers, and buyers are able to make a more informed financial decision instead of just jumping right into the market. So we're coming in a bit lower and not offering those crazy appraisal gaps with our buyers and inspection waivers that we were seeing in 2021 and early 2022. So to sum it up all nicely, you're like, Lori, let's sum it up here. I'm going to say the spring and summer Colorado Springs real estate market in 2024 is about one word: timing. It might be a good time to jump into the Colorado Springs real estate market with historic trends of a great investment for you and your family, but it's about timing, meaning watch specific neighborhoods, waiting to find the right lending incentives, locking in those lower interest rates when they become available. It's very important. As we watch the spring and summer market, we expect more buyers to come out of those woodworks. They've been hiding for a while with the predicted lower interest rates. So while we're still expecting our clients to have more negotiating power and being able to get them into a great financial investment for years to come, which is something we pride ourselves on. So are you ready to find your dream home here in Colorado? Let's begin to prepare for that move in 2024. Let's talk about timing, local lending, how to line up the state-to-state move with schools, jobs, and contingencies on those homes. So drop those numbers into your phone and reach out. We love what we do. We absolutely do, and we're good at what we do here. Check out our 5-star Google reviews. Our clients all have great equity walk in, and we're great at negotiating. We know our local markets and schools. So make sure to reach out when you're making that move. So until next time, we are out from Colorado.